So when you look at the age of the true tertiary, we are finally here. We're also in the age of the true far-flung suburbs. Look at Austin. By the end of this year, Austin will become the most expensive city in the nation outside California. When I look at Austin, the only true far-flung suburb is the city of Killeen, 52-minute drive from North Austin, which is, of course, the part of Austin that's blowing up the most. You can have your cake and eat it too. You can live in Killeen and work in Austin. So I'm talking about two things: true tertiaries. Idaho Falls is one example. St. George is another example. And then far-flung suburbs, which are 50 or 60 miles away from a metro. These are the hybrid work phenomenon. I think they're the biggest opportunity in real estate.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe with Four Oaks Capital. Got a one-of-a-kind, maybe it's going to be a future trend show today. Usually we bring on two different guests, an experienced and aspiring investor. Today we have the one and only Neal Bawa. So Neal, welcome to the show.
Thanks for having me on the show, Brian. Excited to be here.
Yeah, appreciate your time and very much appreciate you coming on the show today. So we're going to talk about some things that are, I think, near and dear to my heart today. But before we do that, let's talk about you. Can you give us an idea of who you are, where you come from, and what got you into multifamily?
Sure. I'm a technologist, a data scientist. I'm based in the San Francisco Bay Area, so steeped in Silicon Valley culture and style, and got into multifamily in reverse. Most people get in by buying a single family home for rental, or maybe they do some private lending. In my case, in 2003, my technology company decided to build their own campus, a la Apple spaceship campus sort of style, basically build something that was custom designed for their own use. And as chief operations officer of this company of hundreds of employees, I was put in charge of that by a CEO who was way ahead of me in these matters and really knew what he was doing, and so was a tremendous guide. And we built that campus while in a 12-month crazy time frame where our company grew 30%. And so we were working hard on growing the company during the day, and then basically building the campus at night. So like doing all of our action items in the evening. And by the time I was done, I had a year's worth of sleep debt, but I also had astonishing chops when it came to new construction real estate, and that's really what got me into real estate. And then from there on, I moved on to single family, followed by small multifamily, followed by very large multifamily, and here we are in 2020. My company got sold in 2013, so 2021. Sorry, 8 years. And we have a $500 million portfolio with 550 investors, and it's value add multifamily and new construction multifamily for the most part, though we have student housing and self-storage and industrial in there as well.
Yeah. So you took the same path as a lot of other people, single family to small multifamily to the large multifamily. Very, very, very interesting. Why did you choose single family up front?
Should have basically had the balls to take all of the learning from my real estate development and applied that. And so the right path for me, I should have gone straight into development. If I had, I'd be hundreds of millions ahead. But I didn't, because you don't somehow magically connect the fact that you built one, or in my case 6 different campuses with competency with taking other people's money. I mean, that was our money, that was the company's money. And so I didn't connect that. And it's like, well, that was the biggest miss of my life, that I had competency and I should have just jumped into large multifamily new construction, in 2006, 7, 8, 9, whatever that may have been. But because I was insecure, I was like, okay, I think real estate is a pretty awesome thing. I love these tax benefits. I have the big fat tech salary and I live in Taxifornia, so I'm working for the man. And so real estate is awesome for these tax benefits. I've never seen anything like it anywhere else. So I want to jump into real estate. Well, what can I do? Well, the answer is single family. And as I started researching and collecting money, I was, very conservative. I'm Indian, very conservative mindset. And so I'm collecting money and money and money. And by the time I'm like, I have enough money, 2008 happens. And now everybody's telling me you would be the greatest idiot of all time to get into real estate. But I'm a mathematician, I'm a statistician, so I'm looking at the statistics and I'm saying my stats are saying this is the greatest time ever to invest in
Yeah.
real estate. Why do you think it's the worst time? Well, because prices are falling. And I'm like, how is that a bad thing?
Yeah. It's like a sale.
So, right. So it's like a sale. So nobody would listen to me. My family basically stopped talking with me because every meeting I would bring up how great it is to invest in real estate. And they would all, basically say real estate's the worst thing ever.
Yeah.
This is 2009. Every party, every discussion is about bashing real estate.
Mhm.
And here I am, the only guy on the other side, taking it from like 6 people who are telling me how much of an idiot I am. So
Yeah.
eventually I basically say, I'm going to prove all these people wrong mathematically. And
Mhm.
that's how I got into single family real estate. And we can talk
Nice.
about that.
Yeah, yeah, and I like your honesty there. You said, there was you should have gone straight to multifamily. You should have, but there were things, personal things that held you back. And I think a lot of people are dealing with those exact same personal issues. So I appreciate you bringing those up. I bought my first single family investment property in 2007, not knowing the market would crash, and then the market crashed and I was still cash flowing, and I'm like, wow, I'm going to buy another one. My big mistake is I only bought one more at the time. I didn't try to, buy more and more and more and more. But
yeah, so I mean, the difference there was I'm so steeped in math, and math really helps me do lots and lots of different things. I bought 10 together to
nice.
prove my point, and so it's an interesting story of how I bought 10 in a city that had no tenants,
Mhm.
and why I bought 10 instead of one, and how I leased them up. But I think part of it was because statistically I felt like my chances were actually better with 10 than one, and they were.
Yeah. Yeah. And I actually have 2 degrees in math, and, mathematically I can make it work, but the risk level for me, that's the reason I didn't. I mean, mathematically, back in 2008, I thought, man, I should buy, 1,000 homes right now. And the risk level, when I looked at, where I was at and everything else, it was too big of a risk for me, to be honest. But like I said, I wish I could go back and overcome those personal hurdles and have invested, as much as possible. But well, cool. That said, let's start talking about these disruptive trends. I've seen this very fascinating webinar that you've given on the top 10 disruptive trends. Let's start talking about the things that are disrupting the market right now.
Absolutely. So the one that I like to start with, because it really sets the groundwork for all of the other disruptive trends, is hybrid work. So after a lot of research and after reading hundreds of articles that are coming from different companies, here is our hypotheses. There are 22 million white collar workers in the United States. They work at a desk, or they work at a computer, basically.
Yeah.
These 22 million people have now become freed from where they work. And you might say, yeah, well, the US is 330 million people. That doesn't sound like a lot. No, well, our working population basically is around 200 people. So 1 in 11 people, 1 in 10 people has completely become freed, where they can work anywhere, right? Now, and you might say, well, yeah, but their companies are still wanting them to come in 1 or 2 days a week. Yeah, but yes, but the number of companies willing to accept and be flexible and willing to basically accept the fact that you can live in one city and work in another is somewhere around 50 and 100 times higher than it was 18 months ago. 50 to 100 times more companies are willing to accept employees that completely work remotely. And so those 22 million people, and there's actually, when you talk about white collar workers, there are about 70 million of them. So only a percentage of them have this ability. Not every company is willing to do it. Right. So I'm only looking at that percentage that has that ability. Of those 22 million people, only about 1 million, the early adopters, have moved so far. And so all of this talk of the churn that the United States has experienced in the last 18 months of people moving for their jobs and moving to Phoenix and Boise and a bunch of other metros, Austin, is just the early adopters, just the first 1 million out of 22. And the remaining 21 million haven't moved for a variety of reasons. One is, COVID's still here. And the second thing is they've got family. So it takes them a while to make that decision to say, I'm going to move because it's better for me, even though it takes me away from family. We are forecasting that over the next 5 years, those 22 million people will move. And when those 22 million people move, it completely changes real estate in the United States. And we call this phenomenon hybrid work. We
Yeah.
call this phenomenon the fact that a percentage of the US population is now going to work remotely. And once again, I keep emphasizing this to those of you that are like, nah, Apple wants people to come back. They're only giving them 2 days off. Apple's one company, right? Out of 70 million white collar workers, we're talking about 22 million, of which 1 million has moved, and it's already changed real estate so dramatically. So hybrid work is this astonishing phenomenon where something that should have happened over the next 20 years accelerated so much that it's now going to happen over 5
Yeah.
because not because of those 22 million people. So the biggest impact from hybrid work is not the 22 million workers, it's the fact that we have now trained 3 million CEOs on how to manage workforces.
Yeah.
So those 3 million, firstly, were resistant to remote work and hybrid work. And secondly, would not have gone there if this kind of calamity had not happened. But those 3 million companies have now pivoted, allowing people to work remotely and giving them all the capabilities to work remotely. And a lot of the CEOs discovered, holy crap, we made more money. Our net profits are going up when we do remote work. So when 3 million CEOs see that, and when 3 million advisory boards and boards of directors, see the profit and loss statement, that changes things forever. Hybrid work means that we are now in the first full year, 2011 is the first full year of the true tertiary market. The word tertiary was misused in the past because people would consider a place that's like Buckeyes, 45 miles from Phoenix, and they would say, Buckeye is a tertiary market. No, actually, Buckeye is just a suburb of Phoenix. People drive to Phoenix, right, especially to western Phoenix, all the time from Buckeye. It's a suburb. It's just a far off or far flung suburb. A true tertiary market is a market that's not within 100 miles of anything else. St. George is a true tertiary market because Las Vegas is 120 miles away and Salt Lake City is 160 miles away. Idaho Falls is a true tertiary because in one direction you have to go Salt Lake City. Once again, that's 3 hours. In the other direction, you have to go to Boise, which is
That's
more
4
than 3
hours.
hours.
Yeah.
Right. So when you look at the age of the true tertiary, we are finally here. We're also in the age of the true far-flung suburbs. My best example is look at Austin, hottest city on the planet. It is, by the end of this year, Austin will become the most expensive city in the nation outside California. Most expensive city in the country outside California. Wow. And yes, I include New York in that, by the way. It will surpass New York in terms of how expensive it is to live there, right? Compared to its salaries, which are also going up, but they're not going up as fast as the home prices and all the other expenses are. So Austin will become basically beyond just the San Francisco Bay Area, Los Angeles, San Diego, the most expensive city in the US. Now it has a far-flung suburb. When I look at Austin, the only true far-flung suburb is the city of Killeen, 67 miles north of Austin, 52-minute drive from North Austin, which is, of course, the part of Austin that's blowing up the most expensive part of Austin, the part there with the fancy places that have these huge towers. All of that is North Austin, and it's 52 minutes. Yeah. So Killeen, in my mind, becomes the new Sacramento to the San Francisco Bay Area. Sacramento is 114 miles away. And more profit has been made in Sacramento in the last year and a half than in San Francisco itself because people moved. They moved 100 miles, right? Yeah. Well, Killeen's 67 miles. You can have your cake and eat it too. You can live in Killeen and work in Austin, and you can come in 2 days a week or even 5 days a week if you're working in North Austin, where the Apple campus is being built and the Google campus is fairly close by. That's hybrid work. It is a massive thing that changes. And I could go on and pick every city in the United States and tell you what far off, metro is going to, become. So I'm talking about two things: true tertiaries. Idaho Falls is one example. St. George is another example. And then far-flung suburbs, which are 50 or 60 miles away from a metro. These are the hybrid work phenomenon. I think they're the biggest opportunity in real estate.
Yeah. Now, looking at the hybrid work, I mean, I think for many years, and my philosophy was I wanted to live close to work to minimize that commute time. The closer you get to the city center, the more you pay. And I think, what the trend really is people are, if they're only going to work twice a week instead of 5 times a week, now that commute doesn't matter as much. They can live a little further away and they get more bang for their buck, and I think that's the obvious answer for a lot of people. And I mean, I just moved from DC to Idaho Falls myself. And so I'm part of that trend. I'm working from home Not quite the hybrid, but part of that trend, living somewhere where I want to live and not where I have to live, and doing everything remotely. So yeah,
Right. And I want to clarify something,
yeah,
Brian.
please.
So the word hybrid work
Mhm.
implies that you're working in the office 2 days a week and you're at
Yep.
home 3 days a week. That's actually not the definition of hybrid work. Hybrid work is a term that implies that a significant portion of the American white collar population will entirely work from home,
Mm.
while a larger chunk continues to work, 2 days a week at home and 3 days a week in the office. So hybrid work doesn't actually imply hybrid work. It implies that the workforce has now split,
Okay.
right? Where a smaller portion just works from home because they want that freedom. They're willing to give up some salary and other benefits for that freedom. We've done surveys, we've looked at surveys of those. They are mind blowing. They're willing to give up salaries, they're willing to give
Mhm.
up perks, they're willing to give up salary increases because COVID brainwashed 7 billion people. We think differently now. People want that park, that open space.
Mhm.
So even the people that are going into work 2 days a week are now likely to buy homes 5 or 10, 15 miles further away than before because they're chasing openness and low density. We are
Mhm.
all trained now that the world needs to be a lower density place than 18
Yeah.
months ago, right? I mean, being next to somebody, people are just uncomfortable standing next to somebody, for let alone touching them.
Mhm. Yeah, I think that trend existed prior to COVID, but COVID just gave it a huge kickstart. It really accelerated the trend. I think probably accelerated, maybe 20 years in an 18-month period where the world was going like that. People were moving from
Yes.
high density to low density places already, from high cost of living to low cost of living already. But COVID really accelerated the trend that I think was already there.
And then technology is going to accelerate it further.
Mhm.
So we know, what are the hottest things in technology right now. You've got the cloud, you've got AI. Here's my prediction: three
Mhm.
years from now, the hottest category in all of technology, hotter than AI, hotter than the cloud, is going to be enabling remote work more effectively. I
Mhm.
am now seeing in the last 18 months hundreds of startups launch. Most of them will fail, but some of them will end up becoming 10 billion and $100 billion companies. We're seeing companies like Zoom and Slack benefit
Yeah.
from this, but they were still pre-COVID companies. In a post-COVID world, the mantras have changed so much that now there's a whole bunch of new startups starting. For example, startups that have multiple cameras, so three-dimensional cameras, allowing you to have a holographic projection of you in rooms, so that when we are all sitting in rooms, we're not seeing each other in 2D. I can see you right now, Brian, in 2D.
Yeah.
But if there were three cameras on your side and three on my side, right, or one camera that had three different lenses, I could see you in 3 dimensions,
Yeah.
and we could actually virtually be sitting in a room where I could see everyone in that room. And as they turn on their side, I would see them turn in my virtual camera
Mhm.
room, right? Imagine that, sitting in a room together. And the computing is doing all the magic in the background to make that person seem like they're in a room, not sitting in their own house. There's 100 companies right now doing this, and every one of them is getting funded because of COVID.
Yeah. Yeah. I love that. Now, I mean, the downside to that is I'd have to clean my whole room instead of what's just right behind me. But
No, 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 no. So one of the things that's happening is you need a better graphics card,
right.
but there's also 20 different companies basically saying, how do I take Brian's,
Mhm.
just Brian and his white shirt with the red, with blue checks or whatever it is that you're wearing, and his head, and I remove the background. And then I want Brian in 3D. So I need
Mhm.
multiple cameras. If I have three cameras and I can remove the entire background, I can take Brian and I can place him anywhere in the world.
Yeah.
So the backgrounds are simply going to cease to exist.
Mhm.
And that's kind of the technology side of hybrid work. But what I'm postulating is this: you're going to see these cities like Buckeye, Arizona, that are 45 miles out of Phoenix, explode. You're going to see Maricopa, which is about 40 miles south of Phoenix, explode. Then you're going to see true tertiaries, St. George, Utah, Idaho Falls. I could probably give you 20 other examples of 20 different places. Kennewick, Washington, I think is going to see explosive growth, right? You're going to see all of these cities in Oregon that are like 100, 150 miles away from Portland are going to see explosive growth. That is our postulate, and we are tracking data, and
Mhm.
the early data suggests this. For example, I mean, you think about Idaho Falls, right? I'm taking it as an example because you live there now. You don't ever think of Idaho Falls as a city. This is a city of like, a metro of less than 200,000 people. You don't ever think of it as home prices there in a year are going to go up 34%, right? You'd say, well, yeah, it's COVID, so everywhere in the US is going to go up 10, 15, 16%, but this is probably going to be at the lower end of that because it's by itself. There's nothing around it. 34% is the home price growth in Idaho Falls. So it's crushing home price growth in Phoenix, right? The only city that's coming close to is maybe Austin. But if you look at what it's crushing San Antonio, Houston, Dallas. It's crushing superstar cities. So already in the first year, our postulate of hybrid work has some data to support it.
Yeah.
It's already
now how does, I know this is one of the data items that you track, and one of the things that you say when you're analyzing areas, look at median home price growth. How does a growth in median home price translate to the growth in rents, for example?
We'll give you a rule of thumb. So here's our rule of thumb. And the rule of thumb has had to be modified a little bit because of COVID.
Yep.
So before COVID, the rule of thumb was that whatever your home price growth is in a certain year, the following year, you'll get about 40% of that as rent growth. So 40%. So for example, if you had 6% home price growth in a certain market in a certain year, then the following year you'll get 40% of that, which is 2.4% as rent growth. Now, usually we found that number actually is between 40 and 50%. So it's consistently been a little bit over 40%, but we were comfortable with our 40% rule of thumb. In a post-COVID world, what we've seen is it doesn't take a year for that to happen. What we're seeing is that year that it takes for home price growth to show up as rental growth has actually been compressed to 6 months, and we are now more consistently seeing a 50% number, right?
Wow.
So, like for example, I'll give you this is the most crazy over-the-top example anywhere in the U.S. Boise, Idaho had massive home price growth, right?
Yeah.
So 35, 40%. But its rent growth, depending upon which provider you take the rent growth from, is over 60 or 80% of that home price growth, right? That's a crazy example because that means rents in Boise went up between 20 and 30% in a single year, right? And it hasn't even been a whole year. It's kind of like 6 months after home price growth. And a lot of people are like, why are these two things connected? Home price growth, rent growth and home price growth, these are not the same. The answer is this. Every time home prices grow faster than inflation, they throw off a large number of people that almost were homeowners, but they just couldn't get there because home prices went up and now their debt to income ratio just doesn't work. They can't get a loan for the kind of home that they want. Now, these people, because they're so unhappy, it's like we were almost there. They don't go into low-end multifamily. They go find nice, upgraded, higher end multifamily, something that's been rehabbed, something that looks like that home that they were going to buy, right? So those people are the ones that drive rents up, because to drive rents up, you need enough people that want upgraded multifamily, not traditional multifamily, but the ones that we upgrade, and that's part of our job. And that's what drives rents. So consistently, what you'll notice is if home prices are going up 20% somewhere, you'll get 40% of that rent growth. That's 8%. By the way, in our world, 8% is a mind-boggling number. And there are dozens of markets in the United States at double-digit rent growth for the last 12 months. Double-digit.
Yeah. And as a syndicator and as somebody who's trying to purchase properties, it almost makes me, I get very uneasy putting an 8% rent growth projection on my spreadsheets, just because, it brings a little bit of risk in there. But, if we're using that rule of thumb correctly, 40% of whatever the single family home growth was, I think that gives us somewhere where we can justify those numbers and perhaps pay a little higher price than we normally would.
That's a good rule of thumb. We don't even use it ourselves. We tend to use 30%, because even today with 30%, if a metro has had 20% home price growth in the last 12 months, 30% of that is still 6%, and 6% rent growth would justify the purchase prices that people are offering today. Now, the only catch is what you can't do is to do 6% 2 years in a row. You can only do that once, and then after that, you have to trim it down. Maybe you go 6.4 and then 2.5. 2.5, I think, is our long-term target at this point for rents because inflation is higher than it was in the past. So we no longer have a 2% trend line. We have a 2.5% trend line for the future.
Yeah. I think that's a good solid way to do it. One year rent growth, you can justify a little higher number on there. Second year more moderate, and then go back to your inflation rate. And the Feds, it looks like they're going to keep 2.5 to 3% as their target. From what I've heard, read Wall Street Journal. That's where I get most of my information. It looks like they're going to keep 2.5 to 3% as their target for a little bit. But we'll see. We'll see how that works. Yeah, right. So we had 5% last year, if you believe what the Fed puts out. So let's talk about something else that I think a lot of people are interested in. There's this tokenization effort as well that you talk about. How is that affecting the real estate market?
It's not affecting it yet, but it is the biggest impact in the real estate market in the last 20 years. So the example I like to give is, if you look at 1997, we had this enormous industry of travel agents. Every single strip mall had a travel agent.
Yeah.
Then 6 years later, they were gone.
Yeah.
Right? Just an entire industry over 50 years old, just gone in 6 years. Right? That is the kind of impact that tokenization brings to real estate, but in a good way. And let me explain why. Real estate is many hundreds of times more illiquid than stock.
Yeah.
Right. So think about it. I want to buy a single family home. Imagine the research, imagine the outreach. I have to talk to lots of brokers. I have to drive for hours to the place that see a property, then drive back another time. And even if I buy the property, then I have to rehab that property today because they're too expensive today to just put on the market. You got to rehab it to get positive cash flow. By the time you get to the point where, boom, this property is now on autopilot, you have spent many hundreds the amount of time that it would take you to pull out your phone and buy 10 shares of Apple or 10 shares of Google.
Yep.
So it's fair to say that real estate is many times more illiquid. Sorry about the sun
No worries.
on the side coming in from the blinds. Real estate is many hundred times more illiquid. And that is why, even though all of us love to point out the fact that real estate beats stock markets in its gains for the last 5 years, 10 years, 20 years, 30, whatever time frame you pick, it beats it. That's why the stock market's more popular, because people are addicted to buying stuff on their phones. They get a good idea from somebody, they just want to go on their phone and click and buy. Here's our prediction. 3 years from now, somebody watches a podcast that Brian is doing, and he has a guest named Neal, and then Neal comes back and says, I am saying Idaho Falls is the best place in the universe to buy real estate, right? I'm not saying that, but if I was, here's what is going to happen. People will take phones out of their pocket. They'll tap on some random app, and there's going to be 20 of those apps, just like Robinhood, or maybe even it is Robinhood. Maybe it is E-Trade. Right. And they will type in Idaho Falls, and they'll see hundreds of stocks that are basically tokens. They call them tokens in the real estate work, but essentially it's a stock. And that stock, it has a $50 or $100 fixed value at this point in time. And that stock is connected to a multifamily or a single family home, or maybe even a parking lot, a performing parking lot that's being rented out. And they will say, Idaho Falls, I'm going to buy $100 worth of this house and $100 worth of that house and $100 worth of that house. And I'm going to buy $100 shares in 10 different houses in Idaho Falls. And now I don't ever have to worry about who's renting this home, which property manager is taking care of it, where's the contract, because tokenization is the process of taking care of all of those things. No one ever worries about the fact that Google or Apple could steal the money that we've just invested in them, right? Because there's a company and a process and a set of laws that apply so that Google can't steal our money and Apple can't steal our money. So we never even think about that. Imagine 3 to 5 years from now, you're thinking, like, this is there's this intermediary company. It's their job to figure out, all of this stuff. No one can steal my home. I own 100% of this home, or $100 worth of this home, not 100%. That's tokenization. It's so incredibly powerful to be able to simply get a tip about Destin, Florida is an awesome place. And then on my phone, 10 minutes later, I own $10,000 worth of 50 different homes in Destin, Florida. That's the future of real estate. When we get there, the stock market better watch out, because we think that real estate is going to become the big dog.
Yeah. Yeah. And there's a lot of reasons that, real estate should be the big dog. A lot of people look at real estate, and this is something that I look at. A lot of people look at real estate as an alternative investment. I think real estate is the original investment, and the stock market's really kind of the alternative. But yeah, I love the idea. I'm curious what it would take to get there and how everything would be set up. But
well, let me give you an actual example, so you can basically say this. So there's a company, I'm not part of them, I'm not invested in them in any way. It's called Lofty, Lofti .ai. So they're not lofty.com, but lofty.ai. So you go in, you type lofty.ai into the browser. Right now, there's a property. It's in Cleveland. It's 4245 East 177th Place in Cleveland. And you can buy pieces of this property for $50, and they're not getting a loan on it. There's no lending. So it's actually much more secure than a typical investment, because we get loans. And what they're forecasting is 6.2% cash on cash, 11% appreciation. So a 17% IRR return. I don't know if they're going to hit that return.
Yeah.
But here's my point. Before, if somebody came to you and said, hey, become a partner with me at 4245 East 177th Place, Cleveland, you would say, oh no, I can't, because I don't know anything about Cleveland. And if I give you $25,000 or $50,000, that money is going to be sunk.
Yeah.
But today, you don't know anything about Lofty.ai, but you can know everything about their properties by investing $50.
Yes.
And so what I've been doing is every single time they come up with a property, and they're coming up with properties in lots of different places. They had one in Detroit, they had one in St. Louis, one in Cleveland. I put $50 in it, right? Because I'm interested in gaining intelligence about what it is that they're doing. And as for $50, I get the same visibility as I would traditionally get in a $50,000 syndication, right? Now, you might think, well, this might be bad for syndicators like me because it's commoditization. Yes, but commoditization increases prices because the number of buyers increase.
Yep.
So cap rates decrease whenever commoditization occurs. If you look at the stock market, as E-Trade and all these other Robinhood made it easier for people to invest in the stock values went up, not down.
PE ratios went down.
Effect.
Yeah,
PE ratios have gone down across the world. Every major market where people are buying, stuff through apps, PE ratios are down. So it's a worldwide effect. Imagine that applying to the market, and imagine for $50 having all the same intelligence about how a property is performing. Now imagine 10 different companies like Lofty.ai. That's the world we're about to live in. I'm incredibly excited about this, because this is a sea change. This is a bigger change than the 2014 Jobs Act.
Yeah. So, right now, there are a lot of companies that are doing crowdfunding, which allows people to do exactly what you're saying. And you're saying the next step is taking, this crowdfunding, very small chunks of money, get you pieces of large properties. And you're saying that they're going to turn the industry into a very liquid industry, where now those shares are marketable instead of being unmarketable shares like most of them are right now.
Right now, I can take the $50 that I spent on the 4245 property in Cleveland, and I can sell it immediately. So the difference is, when you do crowdfunding, it's an illiquid asset.
Right.
But tokenization puts the asset as a token on the Bitcoin, basically the back end of Bitcoin, right? And anyone can buy it as shares in the real time. So you're now actually transacting your tokens. And so it becomes a liquid asset. So crowdfunding, in my mind, was a great idea, but was a precursor to the truly powerful technology of tokenization. And we're finally there. This year, I've seen multiple companies like Lofty.ai. Once again, I don't know if this company is going to perform or not, but hey, I definitely have $50 to know whether they will or not.
Worth $50, so right?
I'm basically investing whatever the minimum is across all of these companies that I can find, Propi, Safe Harbor, whatever company I find. It's like, I'm going to give you $50 because right now I need to learn about this stuff, because this is the most powerful change in real estate technology in 20 years. It wasn't Zillow. It's tokenization that completely changes real estate forever and makes it a liquid asset class, completely liquid.
Yeah. And what you said, and I'm just going to, rephrase this, but what that's going to do to prices, and it's going to make prices go up just like the stock market did. Once people can buy and sell in an instant, a lot more people are going to put money into it, which is going to necessarily make prices go up. It's just a supply and demand problem all over again. And prices are going to go up, cap rates are going to go down, which just basically makes real estate even a more attractive asset to purchase right now and in the near future.
It does. Absolutely. And we are beginning to see that early impact. And it's not just multifamily. People might say, no, people are only going to bother tokenizing. No, this company is only tokenizing single family, right? And the reason why they're able to do it is that they don't need leverage. They're just buying the entire property with your $50 tokens because they've got 4,000 people providing them with $50,000 tokens. So they're completely liquid. They've taken the lenders out of the equation. I think that's a superior model to what we are used to doing, because we still have to pander to everything that the lenders do.
Yeah.
These people are going in with 100% equity. Now, of course, when you go in with 100% equity, guess what? It's harder to generate returns because there's no leverage. When it's harder to generate returns, prices go up, cap rates go down. We're going to see that in the marketplace.
Okay. Yeah. So, and I mean, the traditional model with real estate is to take advantage of the leverage. So interesting. Yeah. I'm going to have to chew that over a little bit, but
I'm not saying that's going to go away. I'm saying that a new model will come in. It'll be extremely powerful and extremely liquid, and it will not necessarily need it. If you think about it, there's no leverage to stocks. When you invest a $50 stock, you invest 50 actual dollars. That no one gives that company any lending. But how does a company get lending? A company goes public, and because they trade on the stock exchange, now they can get leverage from banks by simply issuing shares or doing all kinds of other things. So understand, Brian, that the model of lending in this new world changes. There is leverage, but it's a different kind of leverage.
Interesting. Yeah, I think I love the trend. I love the idea. And my mind's spinning right now how to take advantage of it with multifamily. I mean, obviously, I think just purchasing multifamily right now is taking advantage of the trend because cap rates. What you're saying is cap rates are going to continue to compress. Prices are going to continue to go up. You add that to the other disruptive trends that we've talked about, where people are moving to the true tertiaries and the far out suburbs. It makes those places even a better place to invest right now. So for many reasons, for the two different trends together, you can comfortably buy in an Idaho Falls or a St. George and know that that asset's going to perform. Whereas 10 years ago, there was a lot of risk investing in a St. George or an Idaho Falls. And I grew up in Salt Lake City, right between the two. So those are two markets that are very familiar to me. I've tracked the growth of both those cities and for the last 20 or so years, but interesting, very, very interesting phenomena. I'm gonna do a lot of thinking on this one now. So, all right. So anything else you want to highlight before we come to a close today?
Yes, fundamentals still matter. So the market is in many different ways supporting you with these super low interest rates worldwide that prevent the Fed from raising their rates quickly. So I think we're going to be in a low interest rate environment for several years before rates go up. I want to also remind everybody else, the Fed started talking about raising rates in 2015. Then they finally raised them a little bit in 2016 and a little bit in 17 and 18 and 19. Overall, they ended up raising rates, I think 4 or 5 times. Please note, cap rates went down in all of those years. So if you are not taking action because you're saying, well, as the Fed starts to raise rates, cap rates are going to go up, then you're not data driven because you haven't analyzed that interest rates need to go up 8, 10, 12, 13 times before historically you actually start to see a flattening effect or a cap rate increase effect, which decreases prices. We're nowhere close to the Fed wanting to do 12 increases in interest rates because the federal government itself will not be able to pay its interest back if they raise interest rates 12 times. So that scenario in my mind is completely undoable. And by that time, the next crisis comes in and the rates fall again. So we are in this world where rates will go up 4 times, 6 times. And when they go up 4, 6 times, it doesn't appear to have the impact on cap rates that it used to. A new paradigm is in effect. And so if you're not taking advantage of that, if you're being paralyzed, then you're simply not learning from what has happened in the last 10 years.
Yeah, I saw an article last week talking about the spread between, interest or the interest rate and the cap rate. And in a lot of cities, that spread has gone to zero or even negative in a couple of places just because of the dynamics. And yeah, the other thing I always look at is I think the national debt's at 27 trillion, and so just the debt service the federal government's paying is a large percentage of their tax revenue every year. So the pressure is on the Fed to keep rates low for many reasons.
Right. They had a choice before. Rates could be low or rates could be high. Today they have one choice.
Keep rates low.
Keep rates low because the government, which now is more and more activist, interfering in what the Fed does. Trump kind of said that line of, look, I'm going to interfere in what the Fed does. And now Biden's like, no, I'm going to interfere in what the Fed does too, because the other guy did it. And so he set a precedent, right? So now you have presidents and Congress is saying, no, we're going to interfere in what the Fed does. And they all want lower interest rates because lower interest rates mean less debt payment, which means that they have more money to spend on everything else and make people happy.
Yeah. They put themselves in, they have their backs against the wall where they can't move interest rates up. It's an unfortunate situation, I guess, as citizens in a way, because that's where our government is right now. But at the same time, it's good short term for business. We'll see how it works long term, but it's definitely good short term for multifamily and for businesses. But
I agree.
Well, that said, I appreciate very much your time today. I know your time is extremely valuable, and the fact that you'd spend an hour with me is I don't miss that. So I don't discount that at all. So very much appreciate your time, and if there's anything I can do for you, let me know.
Sure. I'd love for people to reach out to me if they have thoughts or if they think that I'm, smoking good pot. So the best way to reach out to me is simply by Googling my name, Neal space Bawa. I'm the only Neal Bawa on the World Wide Web. So you'll find all the good stuff and the bad stuff. We do 20 webinars a year that are similar to this kind of content, and they're at Multifamily U. About 30,000 people watch those. So you're welcome to come to multifamilyu.com and watch those.
Yep. And just an endorsement, I've got a subscription to Multifamily U, a lot of amazing content on there. The webinars are, far and above what you'll see anywhere else. So definitely check Neal Bawa out, check Grocapitus out. Some of my partners have invested in several of your deals. So, you're a name that we trust, and, giving the listeners the most glowing endorsement that I can. So once again, Neal, thank you for coming on the show today, and very much appreciate your time.